Nice to see you. I'm going to jump right into my talk. I'm going to talk about where I think we are, where I think we're going, and then I'm going to talk about the kinds of stocks that I think make sense at this moment in the market. There's always questions in the market, and so I have some ideas about what kinds of stocks have the best odds right now. So certainly, obviously, the elephant in the room, it's more obvious than that even. The thing that everyone cares about, worries about, needs to consider right now is the recession question, right? Whether it's going to be severe or gentle, long or short, what it's actually going to be. Traders certainly want a soft landing. Traders always want things to keep going up. And right now, they're trading as though that's already the case, right? The S&P has done very well so far in 2023. And yet we're approaching what is actually the most predicted recession ever. So that's a bit of a disconnect for sure, and that is why this question is so important. And it's particularly important for metals investors because gold obviously performs in particular ways around downturns, and base metals perform in particular ways around downturns. So it's a particularly important question for those of us in this space. I'm not going to spend a lot of time on this because I'm sure all of you, like me, spend time reading the economic news, and we know that there is a very mixed bag of data out there. So this slide is some of the bad things, the bad signs that are cropping up out there, right? Certainly, the key yield curves are inverted, and those are pretty reliable recession indicators, right? When we look back historically, those have been good recession indicators. Growth forecasts have been cut significantly, like this cut to 1.7% for global GDP growth. That's down from 3% from their forecast 6 months prior. So that's a big drop, right? You're going to cut growth forecasts in half. That's significant. We do have also the services and manufacturing ISM surveys are now in contraction territory. Either of those would be significant, having both of them in contraction territory, and I think the services ISM, which I don't have on the slide here, is quite a steep drop. It was a surprise drop into contraction territory. It was expected to remain above 50 and it dropped below 50. So a twin ISM contraction, that's not a good sign either, like those yield curves being inverted. And then that chart that's on the lower left is about how earnings per share forecasts are being cut at a very high rate, and at a rate that, and all we're ever talking about here is indicators, right? This is the way we try and have crystal balls, at a rate that has historically preceded recessions. But, and I feel like I was having a conversation just this morning with someone about how I feel like every day there's maybe one new piece of information that crops up that gives me a little bit, that increases my confidence just a little bit that we're going to come out of this without it being terrible. And so these are some of the good data points that sort of are part of that thought process. Obviously, inflation is coming down. It's still pretty darn strong, but it is coming down. The trends are all in the right direction, so that's helpful. One of the most important things within that is that wage increases have slowed, right? If people are making more money, then that is really the fuel behind an inflationary spike, but those wage increases have fallen. So yet unemployment remains low. So companies are managing to hire people without having to offer them a bunch more money. If we were headed towards a rebound of inflation immediately, those things would not be happening. China reopening certainly matters. How quickly this is going to happen, how much stimulus the Beijing is going to throw at things, yet to be seen, but it can't not help that China is reopening, right? And the iron ore chart that we have there is one of the results of that. And then I think the fact that we did not, so far at least through this winter, we have not had a catastrophic energy situation in Europe is also helping. So here's Jim coming in. I told you all had to laugh at him. He's late. Ha, ha, ha. So the lack, at least at this moment, of an energy crisis in Europe also helping the recession situation. And then there's all kinds of other smaller indicators like air traffic, hotel bookings, restaurant traffic. They're all going up. And so then you get charts like the one on the right there where the market implied odds of a recession keep dropping. So, I mean, nobody knows. Are we likely to have a recession that is gentle? Probably my best guess at this point. But this is the big overhang. And like I say, it matters in particular for metals investors because metals get particularly impacted by recessions. Despite having just gone through this bad data and then good data outlook, I do want to comment that I don't expect the Fed to pivot anytime soon. I mean, we are nowhere near, in my estimation, the point, an amount of bad data, a suggestion that the recession is going to be terrible, that would make the Fed pivot at this point. And I think a good way of thinking about that is that the Fed has never tightened too much. That's not what the Fed does, right? The Fed is scared to cause terrible situations. And so if anything, they step back sooner. And that's obviously what happened in the 70s. They stepped back too soon several times, and that's why we got significant double spikes, triple spikes in inflation. They don't want to do that. They haven't ever done it before. I don't think they're going to pivot anytime soon. Is the Fed hike that's pending here going to be 25 basis points instead of 50? I don't know, but they're going to step back. They're not going to cut rates anytime soon. But the dramatic increases are behind us, and we know that because the Fed funds rate has topped out at about 5%. Okay, so within all that context, everyone in this room already knows that gold has had a really fantastic couple of months, right? We're up almost $300 an ounce. And that's, I mean, amazing, right? I made this slide a few days ago. I'm not sure if it's 19% anymore, but, and the move looks very strong technically as well for what that's worth. So why is this happening? My hypothesis is that gold is doing its hedge thing. But I have a bit more resolution on that statement than just gold is a recession hedge or gold is a hedge in a stock market crash. Gold falls with everything else when the stock market crashes or when things are starting to turn bad. But the reason we all talk about it as an inflation hedge or as protection in bad times is because it bottoms first and starts to rise before everything else. And so then we have to look at the context that we're in. Are we in the first half of a market slide? Well, I think that everybody who's invested in the S&P last year and lost 20% wouldn't say that we are in the first half of a market slide. They would say, I sure hope we are in the second half of a market slide. And so that is my message for gold. I think we've done the part of the correction that would pull gold down. The fact that gold stayed sideways through 2022 was very impressive, right? Despite, excuse me, the US dollar doing what it did and real rates rising and all of that. So gold performed much better than it usually does in the first half of a market slide last year. But I do think that that first half is done. And I think one of the key reasons that gold is doing well today is because we're in that second half where there's confidence out there, at least amongst enough investors, that we're in the part where you want to position for the second half, right? So gold is the thing that you buy in the second half of a recession, a market correction, whatever word you want to use to describe this moment that we're in. It does also certainly help gold that real rates have topped, because certainly rising positive real rates are absolutely a headwind for gold. It definitely helps that the US dollar has not only stopped rising, but started falling. Another tailwind for gold for sure. And like I say, this recession talk has investors looking for protection, and the setup, the details of the setup work better. Doesn't mean that gold doesn't have risk, right? Nothing goes up all the way, continuously. But I do think that that is why gold is doing well right now. And I think it suggests that the metal could continue to do well for some time. Now, the major gold stocks have done really, really well alongside gold. So, you know, the GDX is up, whatever it is, 45% or something, with gold being up 20%. So that's normal leverage for miners. So they're doing well. But juniors, as you might know from your own portfolio or from talking to any one of the number of gold juniors that are in the hall, the juniors haven't had a lot of benefit. They've had a bit. Certainly, we've seen some benefit, but we haven't seen strong benefit on the junior side of things. So I think that matters because it does suggest more opportunity to go as this gold market continues. And then there's this context chart. Now, context only matters if you think that this gold bull is going to move to the same extent that it did in a previous gold bull market. That's what this thing charts, right? This is the GDXJ, so the junior of the gold fund, but it's not really juniors, right? It's still very large operators, just not the hugest, against gold. And we're still very low relative to the crazy highs that those stocks reached back in 2011. Are we going to those highs again? I don't know, but it does give you some context for where these markets can go. And if things really start to get hot, that's the kind of upside that could yet exist. So that's the gold side of the conversation. The other thing that deserves consideration is base metals and silver, which I just lump in there, platinum and palladium as well. Gold is its own thing, and all the other metals I sort of put in the other basket. Now, I probably don't need to tell anyone here that the supply-demand fundamentals for most of these metals are very strong, right? Our inventories are very low, there's supply risk, there's supply gaps going out either immediately or in the very near term. So those setups, but those have persisted for a while, and so they alone aren't sufficient to spark investor interest in base metal stocks. The China reopening story helps to counter that recession concern, right? And the recession concern is really what's hanging over the whole base metal side of things, because copper stocks aren't going to do well if we go into a severe recession. That's a rule, right? There's not a lot of rules in investing, but that would be a rule. I think the thing that's guiding me is that certainly a bad recession would delay this bull market, and it would pull things down before it gets going. A soft landing, which I'm increasingly hopeful is what we're going for, pulls it forward. It makes it happen sooner. Does it mean that it's already started? I don't know. This is the recession question that we do not have an answer to yet. But I think if we get to the point where people have confidence that we are in a soft landing, that this recession is not going to be something dramatic, then I think those fundamentals for the base metals start to really play a role. And the reason that they do is because metals are a value play. And this is the shift that's happened in the investing landscape, right? Since the great financial crisis, and then certainly redoubled or quintupled or something since the COVID crash, speculation has been the thing, right? Fear of FOMO stocks have been the thing. But that does not seem to be the thing anymore. And it makes sense. The monetary landscape has changed dramatically. Debt has real cost now, and probably will for the foreseeable future. And so in that context, growth is in. I meant to say value. Haha, I have the wrong word there. Value is in, growth is out, value is in. So value stocks. A parallel that you've likely seen others make, and that I have made many times, is to the end of the tech bubble, right? The tech bubble was a huge speculative party, and then it ended. And it ended in similar monetary circumstances to what we are experiencing right now. And when that happened, no surprise, tech tanked. Value stocks ran. There was a rotation from growth and speculation into value. And in that context, metals soared because metals are a value play. It certainly helps in any situation like that if there's another force propelling the metals argument. Back then, that other force was China's massive growth story. Very significant consideration. I would say today we have a similar force, which is the green transition. It really, the sea change in demand for metals because of green needs, it's hard to wrap your head around. It's really, really large. And so it's not being discussed right now because nobody talks about growth of copper demand when recession is the thing that's clouding, I shouldn't say clouding everyone's judgment, that's taking up everyone's mind space. But that green transition is really important, especially because we're just coming out of this decade plus where limited capital from lack of investor interest plus corporate conservatism, management teams at big miners have not been focusing on growth. They've been focusing on making money, which is good, paying dividends, buying back stock, not on building new mines. But that leaves us in a situation where there has not been much capital invested in building new mines for a decade. So we don't have the mine supply to meet this ramp up in green demand. And so those things come together to mean that miners, I think, really fit the new investing paradigm that we are going to get once this recession thing is answered. Miners offer dividends, cash flow, little debt, and they have this tailwind of strong supply-demand fundamentals because of the green transition. And I've said this, recessions delay secular shifts. I do think that the green transition is a secular shift. It gets put on pause when things crop up that are dramatic, like COVID, like a recession, but it doesn't stop, right? And so this sort of one of the impacts of the secular shift in investing coming out of the great financial and COVID crises is moving from growth to value. And then the secular shift of the green transition is powering the metals side of that argument further. I think it is also worth noting that real assets are almost always do well out of a recession, and metals are obviously a real asset. I have like 5 more slides right now in 4 minutes, so that's not a great setup. What I wanted to lay out here are my ideas of the kinds of stocks that I think are going to do well in this moment in the metals market. And so I've talked about how I really think that we are set up for good metal price gains once the recession question is over, maybe for gold already, but like in the near term. So miners certainly offer clear exposure to metal price gains. If you can find a mining company that has a re-rating event pending, all the better for you. There's leverage there. Of course, there's risk whenever you add a thing like that to a stock thesis, but these are some examples of companies that are operating miners. So therefore, they should offer leverage to a rising metal price. But these ones also all have sort of catalysts pending, like Bombore for Orezone is just starting to shine. It's doing its re-rate there, hasn't even really started. Silvercrest, same concept, new mine, still needs to be re-rated on success. Capstone has done well. It's great for copper exposure, but there's been a delay in response in the market because it's a copper story, but also because it's spending a bunch of money to build a large new mine. Advanced projects of scale haven't gotten a lot of attention. Well, most mining stocks haven't gotten a lot of attention, but I'm talking about the ones that I think will get attention first as we get into a better market. So they haven't gotten enough attention to earn the valuations that will be justified as 2023 progresses. So Sigma Lithium is an example. Yes, lithium's hot. Yes, I still think lithium will remain hot. This is a company that is just finished building a new mine that's going to get expanded. Lithium's a very tight market. There's not a lot of new supply. This thing has a lot of expansion capacity. So that's an advanced project of scale. Troilus, who you'll hear from here, also an advanced project with major scale that hasn't gotten much investor attention because that's just how the markets have been. Then we get into the under-recognized discoveries or developing resources, and I do think that the weak markets, it's been tough for juniors, right? And a lot of investors, if they decided they did want to put money into gold or silver or whatever it might be in the last little while, maybe didn't want to add on the risk of doing it in a junior stock. And so there's been discoveries or major resource growth stories that, like those large advanced assets, just didn't get the recognition that they deserved through 2022. So here's some examples of stories like that. Vizsla's new resource is stellar. This is a huge asset that's going to continue growing and that will be worth more than Vizsla is worth right now down the road. Silver Tiger, Glenn is going to be the first one to come up after me, so he will do his best to fill in the gaps here. But yes, there's been consistent success drilling a very high-grade silver resource there. Again, I don't think the market's paid a lot of attention. Valor, similar, consistent success, growing mineralization down at Pedra Branca, and then also this bonus of advancing a uranium asset. Another category that I think is worth some consideration is that we just had this downturn that was quite significant and left a bunch of projects, companies stranded. So if there were other companies out there who had the cash and the gumption to go out and do something about that, there was an opportunity in 2022 for companies to really position for growth, to grow their potential through acquisition through acquisition basically in the last year. And so companies that did that deserve another look because they also probably didn't get recognized for that. So I think Montage is a good example of that. They acquired a massive land package right next door to their already nicely economic project. Their first drill results from that massive new land package came out the other day. They're great. Multi-gram gold in long intercepts from surface. It's the kind of thing that can really juice the economics of the mine that they already have planned and half permitted. Heliostar, we can talk about that if anyone wants to come and chat with me about it. Just bought some large assets from Argonaut, a very distressed situation. And I think, not that you can buy the stock in the market right now because it's been halted since the acquisition, but I do think that they are very inexpensive given what they did to take advantage of the market. And then obviously we always love top tier explorers. Now tier explorers are always the riskiest. When they work, darn, do they ever work well. But when they don't, they don't. And we're not yet in a market where I think a rising tide is going to sort of like lift all ships. Hasn't happened yet, right? Miners have moved with gold, but juniors haven't had that buoyancy yet. But always top tier explorers, if they work, they can work really well. So some examples of explorers that I think could do that this year. Max Resources, if you're interested in copper silver exploration down in Colombia, and Sterling Metals. Matt will come up and tell you more about that in just a few minutes here. I'm already over. I never go over. This is weird for me. Stay focused, right? This is an interesting moment in the markets. I think there's a lot of potential. It's not going to be a smooth ride from here. This recession question exists. We don't know exactly how it's going to play out over the next little while. So have a plan. Decide what you want as your balance between those risky junior explorers and larger stories. Just know what you want to do in that balance point. Consider each metal. You shouldn't just buy metals across the board. They all have slightly different forces propelling them right now. I personally am more confident investing in copper, silver, and gold right now than I am in zinc, nickel, and PGEs. I do think that they're going to do well, but I think that there's some difference in timing in this moment. Know whether you are a trader or whether you're going to hold through whatever this market brings at you. And always, of course, have a thesis, a specific thesis for each stock that you hold that will help you understand what to do when things transpire.